So, do a little more work on inventory management. This happens to be my favorite topic. When you have 4 kids, you learn each one is your favorite all the time. So this is my favorite because it's the one we have right now. Okay, so we'll talk about kind of the costs associated with inventory. We'll talk about, this is math, the economic order quantity. What is the appropriate volume of a raw material, let's say, that you should purchase to minimize your overall cost, trading off a couple of things. And we'll finish up by talking about just-in-time inventory and MRP a little bit. We're not going to talk about backflush costing or lean accounting. So if you do choose to read the textbook tonight, don't read those topics unless you're interested. Then read them. So inventory management is the planning, coordination, and control of activities related to the flow of inventory. This is not a discussion about FIFO and LIFO. That's not what we do in this class. It's a discussion of the real management of the inventory. So what are some of the costs that are associated with carrying an inventory? The first and most obvious one is the actual cost of the inventory, the goods. The second are costs associated with the ordering process. Each order, you have to issue and prepare a purchase order. When the order comes in, you have to receive that order and inspect it on the receiving dock. And then you have the three-way match between the invoice, the purchase order, and the delivery records or the receipt records. Have you talked about this three-way match in other classes? So if you think about any given order, it starts off with an order. The purchase order is kind of the document that keys the order. I want to buy this amount at this price. Sometime in the future, it's delivered, and the receiving department, which doesn't get to see the purchase order, they do this blindly, counts the goods that come in and checks it for quality. That's kind of the delivery records or the receiving records. And they do it blindly because human nature is to be lazy. And if they knew the purchase order, they would just say, oh, it looks like there are 100, we're good. So generally speaking, the receiving department knows what's supposed to come in but doesn't know the quantities. And then sometime in the future off of that, the vendor will bill you with an invoice. And so the matching process makes sure that you received what you ordered and you pay for what you ordered. And that's the three-way match. Then you have carrying costs. A carrying cost has two components. It has the real cost of you have to have space, warehouse space, that you're going to store your inventory. So there's the real cost of that space. And then it has an opportunity cost. When you have inventory, you have money tied up in that inventory. When you have money tied up in that inventory, you can't use it to make you money in other ways. So it's the opportunity cost of the investment that you have tied up in your inventory. That's the other part of your carrying cost. You have shrinkage costs. Any of you ever work in a restaurant? You know what shrinkage is in a restaurant? Seems like food from the freezer disappears miraculously. Inventory disappears. Happens everywhere. Happens in supermarkets. It happens in clothing stores. But it's a real problem in the restaurant industry that employees borrow it.
I don't know anything about that.
So you know what shrinkage is. They have that happen too. It's a terrible problem in the restaurant industry. But it's in every industry that inventory disappears. Either theft, embezzlement, clerical errors, got washed down the drain by mistake, whatever the case may be. So that's shrinkage costs. The more inventory you have, the more risk you have of shrinkage costs. Stock out costs. Stock out is when you run out of inventory, so you can't produce goods for a customer. So you either have to act in some kind of an expedited fashion, which usually costs more money to get that for the customer, or you have to tell the customer you're not going to meet their needs. Both of those costs are either real or opportunity. And then you have the quality costs that you have everywhere: prevention, appraisal, internal failure, and external failure costs. Let's talk about the economic order quantity. This is the first of a few decisions we'll talk about when it comes to optimizing your inventory levels. And this is the decision about what is the proper amount of inventory to order in each ordering event. Now, there are lots of different cost components. This is only trading off two of them: the carrying costs, the cost of actually warehousing the inventory, and the opportunity costs on the investment in inventory, versus the ordering cost. Those are the only two costs that we're looking at in economic order quantity. The purchase costs are not going to be affected by the quantity ordered, and we know this isn't necessarily true, that the larger the order, the more likely you'll get some kind of a quantity discount. But for the purpose of the EOQ, we ignore that. We also ignore stockouts and quality costs. And as a simplifier, we just say we're going to order the same quantity at each reorder point. And finally, all these numbers that are usually hard to figure out are known with certainty. So what are the quality costs? It's how much warehouse space you'll need for your inventory based upon your EOQ, and what will be the opportunity cost of capital for your investment in inventory rather than investing in something else that can make you money. So every company should have a required rate of return on their capital. So if you know the investment in your inventory, you can assume that you would have received that required rate of return elsewhere. Just like with the chart we had for quality, you're trying to find the minimum cost between the trade-off of two things. With quality, it was a trade-off of preventative costs and failure costs. Here, it's the trade-off of carrying costs, or a trade-off of carrying costs versus ordering costs. And when you look at that trade-off, and somewhere you have the optimal mix of the two, and that's where you want to be. And that will tell you what your EOQ should be down here, the economic order quantity. So let's see how the math works. The EOQ formula is it's the square root of 2 times your demand levels for a given period, let's say a month, a year, whatever that's going to be, times your ordering costs divided by your carrying costs. And that is the EOQ. Okay, video store. Remember videos? They purchase inventory from Oaks Inc. at $15 a pack of videos, blank videos. That's their cost of each individual video. They've calculated their annual demand is exactly 12,844 packages, and with 52 weeks, they know that they use them at the rate of 247 a week, assuming an even demand cycle. They're expecting a 15% return on investment, so this will affect their carrying costs. The purchase order lead time is 2 weeks. Not so critical at this moment, but we'll see why in a bit. What is their EOQ? What is their economic order quantity? Other information. For each purchase order, each time they do an order, it costs them $209 per order. Their carrying costs are 15% on each video that they have in inventory, which comes out to $2.25. And other carrying costs, the space cost of space, etc., is $3.25 for a total of $5.50 carrying costs per video that's in inventory. So you do your math. It's 2 times 12,844, which is the total demand, times the order costs divided by the carry costs per unit, and you do the math, and you come out to 988 units. That is your economic order quantity. That says every time you have an order, you should order 988 video packs to minimize the trade-off costs between your ordering costs and your carrying costs. At that level, how many deliveries should you have each year? The 988, you divide the total number of videos you expect to sell in a year by 988, and that says you need to have 13 deliveries in the course of the year at that level. Oops, sorry. So your total costs would be your total ordering costs for all of those deliveries plus your total carrying costs, or your total costs for ordering will be $5,434 at that level. And you can try any other order quantity, and you should find at any other level these total costs would be higher. This is the minimum possible total costs for the year. So, same picture we had at the beginning. It shows that the economic order quantity, when you hit this minimum point, is 988, resulting in a total cost of $5,434. So that was the first decision. The second decision that you need to make is when should you do a reorder? Remember, it's a 2-week lead time to get your goods. So you need to make sure you order with enough time so that you get the goods before you run out of inventory. So that brings you to the concept of a reorder point. That's the quantity of inventory on hand that you have that triggers a new purchase order. So the reorder point is the point when it says we need to have a new purchase order and get 988 new videos. Pretty straightforward calculation here. The reorder point is the number that you sell in a unit at a time to your customers times the lead time. And the lead time was 2 weeks. So every time what you do is you're going to reorder, you're going to get your inventory all the way up, and you're going to bring it down, and then at some point here, you're going to reorder to get it back up. They'll come in over there and to get them down again. So you reorder here, knowing that your goods are going to come in 2 weeks later. So we know our economic order quantity is 988. We know we sell 247 units per week. And we know that we have a 2-week lead time. So The reorder point is when we're down to 494 packages in this simple case. That is, that will be enough to get us through those 2 weeks of lead time and then reorder and get ready to go. So if you had an automated point of sale system, as soon as you got to this point right here, you would trigger an order to your vendor. But that's an ideal world, and in theory, your new goods come in, and you have absolutely zero inventory when they get there, but it's perfect because it came in just as you needed it, just in time. In the real world, you'd have something called safety stock. Essentially, you want to make sure that you have some inventory on hand at all times to handle the unknowns with your sales cycle. Because you want to make sure that you don't run out when your customers need the goods. So it's a buffer against unexpected increases in demand, a buffer against uncertainties about your lead time. It's 2 weeks, but sometimes it could be 18 days. Uncertainties about the quality of your supplier. You may need to find a secondary supplier. So you manage your safety stock. It's a trade-off between the cost of stocking out, meaning the cost of not having goods when your customers want it, versus the cost of carrying excess inventory to avoid stocking out. That's the trade-off that you're managing in this situation. So we know their expected demand is 247 a week. The sense is that their maximum demand would be 350 a week. So how much safety stock do you need? You need to have 103 excess units for every given week because you want to be able to handle the max. So your safety, since you have a 2-week lead time, there was nothing in the case that said that the lead time was going to be a problem. So you'd want to be able to handle those last 2 weeks at the maximum level to avoid stocking out. So you'd have to have 206 packages of videos on hand at all times. So you don't allow yourself to go down to 0. You would allow yourself, in theory, if you sold at the 247 level, to never go below 206. Cost of prediction error. Everything we're doing here is based upon, guesswork into the future. Guessing wrong has a cost associated with it. So it's more or less a sensitivity analysis. Maybe you've guessed wrong about your ordering costs. The 209 was way off base. It was really only approximately $98. What's the cost of that mistake? So first, you will recalculate your cost, your economic order quantity costs, with the real ordering costs. So based upon 97.84 rather than 209, what that tells you is you should have had economic order quantity of 676. And that shouldn't be a surprise. As your ordering costs go down, you should be able to order in smaller numbers because your trade-off between ordering costs and carrying costs starts to favor you don't want to carry as much inventory because your ordering costs are not as severe. So now your economic order quantity is 676. But you had the, whatever it was, what was it, 988 as your economic order quantity? At 676, your economic order quantity would result in a total relevant cost. Your ordering costs plus your carrying costs of $3,718 in your total relevant cost. This is how much it should cost you at the correct economic order quantity. But you weren't too smart. You used 988. So what really happened? You still ordered 988 for each order, but the cost was not 209. It was the new cost, the real cost. So you use 9784 for your quantitative analysis. So instead of this being 209, you used your mistaken economic order quantity, 988, times your actual ordering costs, and this is how much you actually paid because of your mistake. You actually paid $3,989. And the difference between this and had you done it right was your prediction error, the cost of your prediction error. So the prediction error cost you $271 in this example. Okay, just in time. First project I ever worked on as a management consultant was a just-in-time project in Smyrna, Tennessee. Who knows where Smyrna, Tennessee is? It's outside of Murfreesboro, Tennessee. You know where Murfreesboro, Tennessee is? Well, they had a big tornado there recently, but it's outside of Nashville. Everyone know where Nashville is? Okay, now we're there. And it was a just-in-time system for, it was the first Japanese car or truck plant built in the U.S. And they were actually doing just-in-time inventory because they were essentially importing all of the components and just doing assembly in the U.S. And so we were tracking all of the components as they were coming in from Mexico or Japan or wherever they came in from. Little sidelight, the first sushi bar in the South was in Smyrna, Tennessee, because the leadership of Nissan wanted a sushi bar, so one of their wives opened it. The things you learn. Okay, just in time inventory. The goal here is to minimize carrying costs. That's why you do just in time. That for a company that would naturally have to carry lots of inventory, where that inventory has a high cost, just in time reduces these significant carrying costs. That could be associated with the warehouse, the handling, shrinkage, and obviously your alternative investments. If it's done right, your cost of ordering also goes down in order to bring that EOQ level to a really small level, which is what you wanted just in time, lots of small orders. You also need to have a low cost to ordering, so you need to have very strong supplier relationships. You need to know that when you ordered a good, that good will be on hand at a specific time. So just-in-time requires long-term agreements between the vendor and the buyer. And generally speaking, the purchase orders, the request for goods are, in today's world, done in an automated fashion. So you take a lot of the lag time out of it. You do need to think about, when you're looking at just-in-time, the purchasing costs. You're getting a lot of smaller orders. So you're, in theory, not getting volume discounts, except if you have a strong relationship with the supplier and they know that over the larger period they'll sell you volume. They'll give you the volume discounts that you would have gotten with larger orders. Stock out costs. a very high risk in just-in-time. If there's a kink in the system, if something doesn't arrive when it was supposed to arrive, the entire system breaks down. So there's a high potential risk for stockout. And quality costs. You're getting a lot of orders, so a lot of review of those orders, so you need to make sure that you have all the preventative tools in place to ensure that you don't have quality problems. Because if you do have a quality problem, that just kind of totally throws your processes out of whack. And when your processes are out of whack, just-in-time doesn't work. It demands a very smooth processing environment. So you need to invest in quality up front. So as you do your just-in-time, you need to understand your entire supply chain. Most companies don't do the entire supply chain internally. Those components that are done externally need to be thought through as if they were internal. Every step has to be in sync. And the supply chain participants need to share information freely. If there's a problem in the chain, you need to evaluate it and improve it. Kind of the opposite of just-in-time that was in vogue and still is in vogue in many industries is MRP, Materials Requirement Planning. This goes in the other direction. Essentially, MRP starts with a budget, like we did. You have a budget, you have a demand forecast based upon your budget, and then you just start pushing product through the door. Think about homogeneous kind of cost leader type of products. My mind always goes to M&Ms. Think about pushing M&Ms out based upon your budgeted, your expected budgets for how much the market's going to bear. That's what MRP does. It starts at the beginning of the cycle. It says, how are we going to meet the demand? So you use the demand forecast for the final product. You have your bill of materials, which we talked about, which are all the components needed to create that final product. And then you determine what inventory items you need to purchase in order to get to that final production level. And then once you get that inventory, you push. MRP is pushing. You create a master production schedule, and it's just pushed through the pipeline. And in the end, you may have accumulation of inventory because maybe the market didn't demand what you thought. Just in time is the opposite. It pulls you through the process. You have the need to produce a product, and it's pulling everything through behind that need for a specific product. So you know you're going to build a car or a truck. What's needed to build that truck? What's needed to build the component? What's needed to each step back? And it's just pulling the production from the specific need of a specific product. So the customer demand, specific customer demand, drives the production product from the back to the front, and orders occur for inventory based upon that very specific demand. So under the just-in-time world, you'll have low quantities of inventories, both raw materials that come in from the outside and inventory as it's going through the pipeline. If done right, you will meet your customer's demand in a timely fashion. If done wrong, you'll have delays and there'll be a problem. And you'll have the lowest possible cost because you're avoiding the carrying costs associated with inventory. You need to have workers that are able to get the job done in just in time, because there will be problems and you need to have people who can figure things out quickly. So you need to have cross-trained, highly skilled employees. You need to get rid of defects, because if everything's being pulled by a given customer demand item and there's a problem along the way, that kind of slows down everything else. Minimize your setup times, because they slow down the process and cause inventory to build up. And you need to carefully select your suppliers. The benefits of just-in-time: lower overhead costs, lower inventory costs. Because you need to eliminate problems, you'll have a higher quality product. And you should be able to reduce lead times if you're doing it correctly. Yes, sir? No, it's kind of the opposite of just-in-time. It's one is a pull approach, just-in-time is a pull approach. The other is a push product through. Get the raw materials and just create end product, and then hope there's a buyer out there. ERP, how many of you have heard of ERP systems? Not too many. ERP, Enterprise Resource Planning Systems, ERP. Big computer systems. Companies like SAP, Oracle produce them, mainly for manufacturing, but they try to fit into the service sector as well. And they bring the entire manufacturing process under a single computer environment. And they connect not only internally, but they also connect to vendors and potentially customers. And so they're fully integrated, and they allow you to have a just-in-time environment because they're well developed and well integrated. They're expensive to implement. Implementing these huge systems, as we've said before, are rife with errors, and there are many cases of failed ERP implementations. But if done well, they are very supportive of a just-in-time environment. Okay. If you have a just-in-time environment, you want to have specific metrics, measures, that will let you know how you're doing with your just-in-time. Inventory turnover. You'd expect our turnover very quickly because you can have very little inventory on hand. You want to make sure your lead times are short and that you're working efficiently. Make sure, just like inventory turnover, you don't have a whole lot of inventory on hand. And setup time and number of defects are two metrics you want because, as we've said, you want to minimize your setups and you want to minimize your defects in a well-run just-in-time environment. So if you are a just-in-time organization, you look at metrics like these to ensure that you're doing it well. Okay. So Chapter 20, number 18. Do it with your team, and we're out of here.